Welcome back to the deep dive. If you're like me looking for a quick, no-nonsense rundown on what's really driving the markets right now, you're definitely in the right place. Today, we're jumping straight into a pretty vital market update, trying to cut through all the noise and get right to the strategic stuff.
That's right. Our goal today is really to pinpoint some of the high probability setups we're seeing across the board: equities, crypto, Forex, even precious metals. And it's not just about, reacting to the CPI data. It's more about understanding the deeper currents, the stuff happening beneath the surface.
Yeah, and what really stands out, what seems to be the main theme, is this pretty intense divergence and capital rotation. You've got some areas, certain indices, just showing incredible strength, hitting new highs like there's no tomorrow. But then other parts, well, they seem a bit tired, maybe hinting that a shift could be coming.
Exactly. So we want to give you a sort of shortcut to understanding the key technical structures forming. We'll look at some historical parallels too, see what they might tell us, and really focus on actionable insights for right now. It's about getting properly informed on the mechanics.
Right. So the big question we're really digging into for you today is this. Are the equity markets, or maybe just key parts of them, actually setting up for a real reversal after this long run? Or is this just a pause, a healthy breather before certain assets take off again? Let's get into it.
Okay, let's start with the NASDAQ. I mean, it's just been on an absolute tear, hasn't it? Still pushing that relentless uptrend, making new all-time highs. Really shows the power of that momentum.
Relentless is definitely the word. But okay, here's where it gets tricky, because the technicals are maybe flashing some warning signs. You mentioned the two-day relative strength index, the RSI. It's sitting at 75. Maybe quickly remind folks what RSI actually measures and why 75 is significant.
Sure. So RSI basically measures the speed and change of price moves. Think of it like a momentum gauge, 0 to 100. Anything above 70 is generally considered overbought. It means things have moved up very fast, maybe too fast, and could be due for a pullback. So 75 is pretty deep in that zone, like you're pushing the engine hard.
Okay, so it's like the market's engine is running hot. But just because it's hot doesn't mean you slam on the brakes immediately, right? You warned against just shorting the NASDAQ based on that alone. Why not?
Absolutely critical point. Overbought isn't a sell signal by itself, not in a strong trend like this. You need what we call a confirmed market structure shift, an MSS. That means a clear break below a recent higher low. That's your structural sign the trend might actually be breaking. Without that, you're just stepping in front of a freight train, basically. You need proof the train is slowing down first.
Got it. Okay, so how do these tops usually form then? Because it's rarely just a sudden cliff dive, is it? There's a sort of pattern to it.
Yeah, there's often a specific sequence. You might get an initial sharp sell-off. Everyone starts talking top. Then, almost immediately, you get the buy-the-dip crowd jumping in, pushing prices back up. But here's the key, the real tell. The RSI doesn't make a new high along with the price. It actually prints a lower high while the price makes a higher high. That's your classic RSI divergence.
And that divergence, that's the signal that maybe the big institutions, the smart money, they aren't really buying into that recovery with the same force. It's more retail, maybe.
Exactly. The conviction isn't there from the big players. They're being cautious. For anyone still holding long positions, the most recent weekly higher low is now around 22,668. A break below that level, that would be a really significant weekly market structure shift. That would signal something more serious might be unfolding for the NASDAQ.
And this high RSI reading, it also lines up with something else people often forget, seasonality, right? September isn't typically a great month for stocks.
You're absolutely right. Statistically, September is the weakest month of the year for the markets. History shows corrections, maybe 7% to 10%, often kick off around August and run into September. So seeing this overstretched RSI now, it fits perfectly with that seasonal tendency for weakness. It's like the market's setting the stage.
So strategically then, considering the hot RSI and this September history, what's the move for current portfolios?
Well, the approach we've taken is to close out most long equity positions for now. The only thing we're holding is gold, which we'll definitely talk about. The idea is just to let this potentially weak period pass, those 8% to 10% corrections. They're healthy, they reset things, they actually create great re-entry points if you're patient. So the plan is maybe look to reopen, reshuffle things in October after the dust potentially settles.
Okay, speaking of gold, this sounds like where the real bullish excitement is right now. You flagged a really compelling, almost explosive setup there.
Yeah, gold XAU looks incredibly interesting. We actually entered a position at $330,350. The stop loss is tight, just under $330,327, protecting below a key level at $3,329. The main pattern we're seeing, especially on the gold ETF, GLD, is very, very clear.
And you called that pattern a clear ascending triangle on GLD. What does that actually mean? Is it like a spring getting tighter and tighter?
That's a perfect analogy. An ascending triangle is a bullish pattern. You see the market making higher lows, buyers stepping in earlier each time, pushing up against a flat resistance level overhead. It shows buying pressure building, squeezing price upwards, and usually it breaks out strongly to the upside once that resistance finally gives way. The market's gathering energy.
And it's not just a triangle. You're seeing confirmation of this coiling, this consolidation on longer time frames too.
Exactly. The 2-week chart, it shows an inside 2-week candle, which just means price stayed within the prior candle's range. Tightening. Even more significant, the 2-month chart has a double inside 2-month candle. That's serious compression. It's like multiple springs tightening across different timescales. It suggests when this energy releases, the move could be really substantial, explosive.
Wow. Okay, now this next pattern sounds unique. You mentioned a rare rainbow pattern on GLD. What on earth is that and why is it important?
Yeah, this is something you don't see often, which makes it potentially very powerful. The rainbow pattern happens when different time frame opens, the monthly, the weekly, the daily are all clustered incredibly tightly together. On GLD, the weekly open is $308.62, the monthly is $308.61, basically identical, and the daily open is right there too. And check this out, the August and July monthly opens, same level.
Whoa, okay, that's incredibly precise alignment. What does that tell you? That all these different time frames are starting from the exact same point.
It signals a massive level of interest, a huge agreement point in the market. It basically screams imminent expansion. Think of it as an incredibly strong price floor, confirmed across multiple periods, massive institutional interest likely anchored there. So a clean break above the recent high, around $313 on GLD, that would likely trigger this pattern's resolution. On the futures chart, that corresponds to $3,300 for XAUSD. That's kind of the line in the sand for the breakout.
Okay, so we have this potentially explosive setup in gold, but wait, its monthly RSI is also super high at 84. Isn't that a contradiction? Especially after what you said about NASDAQ's RSI.
That's a really sharp observation, and it highlights a key difference. Gold behaves differently with RSI. Historically, gold can get way more overbought than equities before topping. We're talking RSI hitting 90, even 95 sometimes. Gold often has what we call blow-off tops, a final, almost vertical spike in price and volatility before it corrects. So this current consolidation, even with the high RSI, it doesn't look like a top. It looks like the market gathering steam for that final dramatic blow-off move.
A blow-off top. Okay, so if that plays out, where could gold potentially be headed? What are the targets?
Well, the first major target we're looking at is $3,600. Then a really strong confluence area is $300,734. That lines up nicely with a 1.618 Fibonacci extension and the R3 yearly pivot. Important levels. And honestly, in a true blow-off scenario, you could even see an overshoot towards $4,000. The invalidation for this whole swing long idea is a break below the current 2-month candle's low, which sits at 32.68.
Okay, let's switch over to currencies. The euro seems to be showing some serious strength, tying into that rotation theme.
Yeah, the Euro EUR has a pretty significant long setup going. It came from an inside 2-week failure pattern, and that expansion is definitely happening now. We're seeing recent highs being taken out. It's a clean technical move suggesting more upside is likely.
And how does that play against the dollar? Because the dollar made some moves recently too, didn't it? Feels like you're telling different stories.
It's a really interesting relative strength story. Both euro and dollar had an inside weekly candle, right? A compression point. Now, the dollar popped above its high. That looks very much like a stop run, pushing price up just enough to trigger buy stops before potentially reversing lower. But here's the key. The euro never broke below its low on its inside week. It held firm. That tells you there's underlying relative strength in the euro. It didn't want to go down. So the implication is the dollar is more likely to run its lows next, which would fuel the euro's move higher.
Okay, but zooming out long term, hasn't the euro been in a downtrend for ages? Like since 2008. How does this current strength fit that bigger picture? Is this a major trend change?
That's the multi-million-dollar question, isn't it? Yes, structurally, on the monthly chart, the euro's been making lower highs since July 2008, a clear downtrend. It's now heading towards a really critical zone, roughly between 1.19 and 1.21. That area has a lot of history monthly liquidity, an untested resistance zone. Technically, if that long-term downtrend is going to hold, testing 1.2, it could absolutely set up a major swing short opportunity, creating another lower high in the sequence.
Yeah, there's a big but here, isn't there? Something that overrides the pure technical picture.
There is, and it's U.S. policy. The technical picture suggests a potential short around 1.2, but that flies directly in the face of the current U.S. administration's stated desire for a lower dollar. And fighting stated government policy on currencies, well, it's usually not a winning strategy. So realistically, the path of least resistance for the euro probably remains higher towards that 1.2 level, unless or until something fundamentally changes with that U.S. policy stance. Policy can definitely trump technicals here.
Right. And if the euro does keep pushing higher towards 1.20, what's the likely implication for the British pound, for sterling?
Yeah, if the euro moves up, the pound GBP is highly likely to get dragged along with it. Now, the pound is also in a long-term macro downtrend since March 2008, actually. And it is approaching a bearish area, what we call an order block. But the recent uptrends suggest dips are still being bought. So for GBP, the advice is really patience. Let the euro play out first. It's the cleaner setup right now. Don't chase the pound.
Okay, so hold off on the pound for now.
Yeah. Now, if sterling gets pushed significantly higher, say up towards 1.38 or even 1.4U, then it could become a very attractive swing short candidate. You'd look for a stop maybe around 1.42, but crucially, you'd need a strong fundamental reason to emerge that goes against that U.S. desire for a weaker dollar. That's the key condition. It's a setup to watch, but not jump on yet.
Gotcha. Okay, let's pivot to crypto, because you mentioned rotation, and it seems like there's a big split happening between the two giants. Bitcoin's been kind of quiet.
Yeah. Bitcoin BTC has really just been grinding sideways for the past month or so. Consolidating, chopping around, not much decisive action. Taking a breather, it seems.
But Ethereum sounds like a completely different beast right now.
Yeah.
You said it went berserk.
Berserk feels about right. Ethereum, ETH, has just printed one of the largest quarterly candles in its history. A massive move up. And this difference, this divergence, is the key takeaway. It signals a very active rotation of capital. Money flowing out of Bitcoin, relatively speaking, and into Ethereum. That creates a really fertile environment for altcoins to perform well, as that capital looks for even higher returns. In fact, looking at the ETH-BTC pair itself, its chart suggests maybe another 10% upside for ETH against Bitcoin. So ETH could continue to outperform.
Okay, so ETH is leading. For people looking to get into Ethereum or maybe altcoins, what's the strategy now after such a huge move? Wait for a pullback.
Exactly. You don't want to chase this massive green candle. The focus shifts to identifying good support zones for the next inevitable correction. That correction is likely coming, maybe September, maybe October, fitting that broader market seasonality we talked about. Where do you look? That prior resistance zone, the ceiling ETH kept hitting before it broke out, that now becomes strong support, a potential floor. So key areas to watch for a pullback entry would be around $3,860 or potentially down to $3,700. There's an untested monthly open there that could act as a magnet. A stop loss for a long entry around there would probably sit below $3,363. If we get that pullback and hold, altcoins should really fly.
Yeah. Now, underpinning a lot of this, especially in tech, is the AI narrative.
Yeah.
That seems to be the engine driving so much of the market rally.
AI is absolutely the dominant narrative, no question. Companies deeply involved, Microsoft, NVIDIA, AMD, Google, Amazon, they're the ones pulling the indices higher. And this whole narrative is going to have, I think, a huge impact on Tesla and Apple, perhaps more than people fully appreciate yet.
And Tesla.
Yeah.
You called it the original AI pioneer? Why frame it that way? Most people think of the newer language models now.
Well, it's easy to forget, but Tesla's full self-driving, FSD, that is a massive real-world AI project. They've been tackling incredibly complex AI problems for years. But the really big catalyst coming up for Tesla is that November shareholder vote, the one about investing in XAI.
Right, XAI, Elon Musk's other company, the one behind the Grok AI. So bringing that into the Tesla fold, what does that actually mean for Tesla? How does that change the valuation story?
It's potentially transformative. Integrating XAI's software prowess with Tesla's hardware and data engine, it could massively boost Tesla's AI capabilities way beyond just cars. Think about robotics, energy, manufacturing, unlocking huge new revenue streams, kind of like what happened with Microsoft and NVIDIA when their AI potential became clear. XAI itself is already pegged at maybe $100 billion. Combine that synergy. Some analysts are seriously talking about Tesla hitting a $2, even $3 trillion valuation by 2026 because of this.
Wow. That's a staggering number.
Yeah.
And it really shows how price drives sentiment, doesn't it?
It absolutely does. Tesla faced so much negativity while the stock price was down or sideways for like 2.5 years, right?
Yeah.
Even though the underlying business was growing, price is the ultimate arbiter of sentiment. And we saw that huge monthly candle recently just obliterate that long downtrend. Sellers just vanished. That was followed by a perfectly normal, healthy pullback and consolidation. It looks like it's setting up for the next major leg higher, fueled by this AI story.
And beyond XAI, what other big growth drivers are on the horizon for Tesla in, say, 2026 that maybe aren't fully baked into the price yet?
Oh, there are potentially massive ones, things like the Optimus robot finally hitting production lines, the robo-taxi network actually launching and generating revenue, and full FSD software becoming a major subscription revenue stream across millions of cars. These aren't small things. They represent potentially insane new revenue streams that most models probably aren't fully accounting for yet. It's way beyond just selling cars.
So, okay, for tech stocks then, like Tesla, like Apple,
No.
how should listeners think about navigating that potential September weakness we discussed? Is it risk-off time or buy the dip time?
September can definitely be that shaky month, that volatility keg that spooks the market. But the strategy here for these strong narrative-driven names is to view any significant weakness in September as a potential buying opportunity. If the market gives you a pullback in Tesla or Apple in September, that could be your chance to get in or add to positions at a better price. Patience and capitalizing on fear.
And Apple, AAPL, also looking strong into year-end.
Yeah, Apple's chart is setting up nicely too. It's forming what's called a quarterly bullish order block. That's a strong technical sign suggesting a push towards new all-time highs is likely in Q4 starting October. Plus, seasonality is huge for Apple. It historically performs very well into the end of the year, often rallying from October into January. So again, if September does bring a pullback, maybe Apple dips towards support around $216. That looks like a primary entry spot to catch that potential year-end rally.
Okay, wow. What an absolutely packed deep dive today. We've hit on so much. That divergence in equities, the potential rotation, gold's super bullish setup with that rainbow pattern pointing towards a possible blow-off, the really clear capital shift from Bitcoin to Ethereum, setting up altcoins, and then this overarching AI narrative really driving the potential for giants like Tesla and Apple.
It's definitely a fascinating market environment, lots of moving parts. As we head deeper into Q3 towards Q4, the key things to watch are those potential market structure shifts in equities. They'll signal if the trend is genuinely changing. And of course, watch how these consolidation patterns resolve in gold and crypto. Those breaks could signal some really big moves ahead.
All right, so here's something for you, our listeners, to really chew on after all this. Think about the implications if gold's rainbow pattern actually plays out and sends it towards those huge targets. Or consider the really long-term impact of this AI catalyst, maybe still underestimated, for companies like Tesla and Apple. What part of this picture, what potential shift, stands out most to you from everything we discussed today? What's the one thing you'll be keeping a closer eye on?
Yeah, really mull that over. Because understanding these potential shifts, their deeper implications, that's where the real insight lies beyond just the headlines.
Absolutely. Thanks, everyone, for diving deep with us today. We'll catch you in the next one.